Returning to the normal daily chart and the theory of gaps and also range deviation, this rally today has, in the June contract, has simply moved up towards the low of the March contract yesterday. So far it's failed by 3 ticks. It's also important to understand that the third range deviation from yesterday was at let's do RP low 3, 124.20, and if we go back to the profile, this coincided with the distribution low down at 124.20 to 25 as well. So another important consideration about profit taking if you were day trading, we're at the limit of range for the day. It's also the distribution low. It's very unlikely that price is actually going to hold below there, and so it's an optimum place to be looking to take your final profits on any short trades that you had for the day. Now we move on to T-bonds in America, and I think it's quite striking that in spite of the equity weakness, T-bonds have continued to trend lower, and so the market has been concentrating on the extra issuance associated with government deficits and ignored stock market weakness. Coming into payroll, yesterday's price action was quite instructive in that we spent time right at the bottom of the trend, so we're accepting value at the low of the trend. We also have control relatively close to the low of the trend, down at 125.08. So again, coming into payroll, there is a chance that price just breaks down and starts building a new lower distribution, and there is obvious key levels above at 125.08 and 125.17. If we start holding above that point, there isn't really anything particularly clear cut until we get into the 127s. So T-bonds also coming into the report have a negative slant. And if we quickly just look at what T-bonds have done since all those interest rate decisions have made, so far overnight we're up over a point, but the high is at that 125.08 control, pretty much to the tick. Very quickly, we're just going to switch our attention to gold, which has been quite interesting in the last month, in that in spite of equity weakness, we've pretty much dropped as much as $100. And now we've come back down to a very, very important area, and this is from the distribution of the highs of last year, and the control point is effectively at just at 900 to 901 at this point here in the longest line. And here we have the current distribution from the 31st of October last year. Now in the pit hours it shows that we didn't quite actually meet that level, but if we go to the daily chart, yesterday we came down to 900.4, and this is an important consideration as well. If you notice, if I go back to the profile, that the when we look at the top of it, it will say that I'm using the primary session only, so I'm only using the original pit hours to do my distributions. But if price goes to any levels that are very important out of hours, then I'm more than willing to trade them. The other important consideration there is that logic, to me anyway, would have thought that a lot of equity weakness might have made a flight to quality in gold, and that it would have gone up. So much for fundamentals. And so just disassociating yourself with what you think should happen and what actually happens can be very important. And for me, what has happened is we've come back down to what is really the optimum place to actually think about getting long again. In terms of where I would be wrong, it is a strategic based trade, and so I would not want price to be accepting value below 877, and then if it really started trading below 850, then it's definitely all over. Finally, we're just going to give ourselves a little bit of an update on the call a couple of weeks ago that looked at the wild differences between dollar yen and dollar Swiss, and how that potentially had the opportunity for the Swiss yen rate to rally quite strongly, and also how dollar yen could rally strongly and possibly dollar Swiss could fall. Since then, certainly the dollar yen part of the equation has worked extremely well. We've rallied nearly 800 points or so, and at the moment price is accepting value at the top of the trend. Control is at the top of the trend, and so it's very clear where this rally would deem to have failed, or where profits would have to be taken from a strategic point of view. Certainly, ideally, don't want it trading below control at 97.56. Certainly don't want it trading into the vacuum around the 96.12 point because there's very little support there. If we look at the previous trend, I've had a target all the way up at around the 102.20 level, which is a distribution high. We could possibly get up to 103.74, and so there's still some room on the upside. And certainly from a classical technical analysis point of view, just looking at the straight daily chart, we've rallied strongly, we've gone sideways for a few days, and now we're attempting to build another higher distribution point. For the dollar Swiss, we said that there was also the opportunity for price to fall, especially if price broke below 114.88. And effectively what's happened in the previous 2 weeks is the market has simply gone sideways, and so there hasn't been a great deal going on. The distribution remains top heavy, but needs to prove itself by breaking that 114.88 point to say that now we can trend downwards. Finally, we're going to look at the cross rate itself and just see how the price action has developed since that point. We had two levels of resistance. We had this 81.25 to 81.50 point, and then we had this point up here around 84 even to 84.25. So let's just see how the market performed since then. The first thing is we tended to stop, if only briefly for a day or two, around that 81 to 81.25 point. And then we had a key day here where we opened, went a little bit lower, and then accelerated higher. And this is again a classic example of how we can connect different analysis together. For those of you who are familiar with range deviation pivots, once we've identified the trend, we look for one range deviation pivot down to be the ideal support point for where we're going to add to that position. And if you look down in the bottom left hand side, I'm just going to actually make this a little bit bigger so that we can see it a bit more clearly. I'm going to make it bold. If I just put my cursor there, we can see that RP low 1 was at 80.47.28, and the low of the day, and this is the index use on CQG, so it's taking an average of price every 10 seconds, had that low at 80.50. I always look to buy a certain few pips ahead of where a range deviation level is, and this was really an ideal point. Not only did we get the satisfaction of buying very close to the lows of the day, price then closed way above 3 up, and so this tells us that there is an expansion of range in the trend, an acceleration in that trend. And if we're looking for a place for the market to have some sort of pause for reflection, then it's the control point of the previous trend, and here this was around the 83.80 to around 84.10 point, and the chart in the subsequent 2 days did stall in this area, and if we continue to merge, it's held value at the top of this trend as it tries to build a higher distribution, and at the moment price is now accepting value above that point. So where do we break down? We have a mini control around 83.34. Ideally, so far today we've held the old control, which is positive, and I really don't want it trading into the 82s because then there really isn't a great deal to stop it coming all the way back down to 79.74. So in short, at the moment for the dollar yen, there's not a great deal of reason to say that the trend doesn't have more room on the upside. We have stalled in the cross rate, but we're accepting value at the top of the trend, and so that remains bullish as well. And for the dollar Swiss, it's really just ambling sideways, and we're waiting for some sort of clue.